After the stellar growth numbers on May 30th, followed by an emphatic GST collection data, RBI last week delivered another positive surprise with a 50 basis point rate cut. With a record dividend providing government room to spend on capex, rupees 2.7 lakh crore was what the RBI provision, and tax cut helping urban demand, will RBI cuts provide further boost to the economy? More important, can India keep its tryst with destiny to become a developed country by 2047, or does it risk falling into a middle income trap? The 4 to 5 trillion mark won't mean much if we stay a low middle income economy. Welcome to Beyond Averages, our weekly data podcast where we try to bring the story behind the big numbers. We have with us Rajnish Gupta, Partner Tax and Economic Policy Group, EY India, and Paras Jasrai, Associate Director, India Ratings and Research, to discuss the country's trajectory. Welcome to the show. Let me take our viewers through a few charts first before I get back to you. The Indian economy grew at a faster rate in Q4 FY25 at 7.4% compared to 6.4% revised for Q3. The last time India grew this high was 8.4% in Q4 FY24. But it's not just the last quarter, the Jan-March quarter growth that worked well. Look at it, and the Indian economy was performing even better in the first quarter of FY26 as well. Look at the GST numbers here. It was 2.37 lakh crore, the highest ever GST collection. And in May, even though it dipped to 2.01 lakh crore, it was the second consecutive month of over 2 lakh crore number for the first time ever. Also, you look at the growth rate, and the growth rate at 16.5% from the previous year, YOY, was the highest ever in 31 months. More important, it's not just the GST collection data that was showing this. You look at how government capex has been performing. Now, capex was low right throughout last year but picked up right in March to 2.4 lakh crore, and in April it was 1.59 lakh crore compared to the last year, and that's about a 61% jump in the capex as well. So investment is working well, which was one of the factors that was doing better in Q4 FY25 as well, and even the GST collections or the consumption is showing a good way for the economy. Now, what is the RBI rate cut supposed to do in this scenario? Now, RBI has cut rates by 100 basis points since the start of the year. 6.5% was what the rate was. It's come down to 5.5%. Although these cuts are not very abnormal, RBI has done it before also, giving 50 basis point cuts. But what will it do to the economy? Mr. Rajnish, first let me get back to you. Will RBI cuts help the economy?
RBI cuts are expected to help the economy. So what it does is it lowers the cost of money. So it serves as an incentive for more investments to come in. There's also a lot of consumption economy which is there within the country, of people buying homes, of people buying automobiles, which gets funded through loans. So the cost of that debt should also go down. So I think the 100 basis point reduction which has happened in the interest rates over the last few months is a positive for the economy, and it should boost both the consumption and the investment side of the economy. And we have also seen a very sharp fall in the 10-year yields for G-Secs. So I think this is all positive for the economy. Also signals a lot of confidence on the part of the central bank that the inflation would be under control. So I think it's positive in my view.
Paras, as we were discussing, there was this point where we were talking about the RBI actually reducing the rate to reducing the inflation part to 3.7%. Do you think that would be a help here Also, in terms of RBI cuts in an uncertain scenario, right, where global uncertainty is playing part, will investment come?
Yeah. So, we our analysis also what we have done, understanding the trajectory of interest rates and the uh, rate of investment rate and also the growth in investment demand. It says that it is a necessary condition, but it's not a sufficient condition. Which basically it means that yes, the falling cuts definitely would give a boost to investment demand, especially at a time where government capex has been a very great enabler. So the private capex, as also the indicated by the NSO's latest private capex data, that the investment demand has been good for the private capex in FY25. So that would be building up. But overall, if one sees currently, there is a lot of uncertainty with the kind of tariffs, and we are yet to see what the US-India deal also plays out. And also, apart from that, I mean, the FDI flows are also a great indicator that, yes, the gross FDI flows have been good, but the net has been declining. So the a lot of other factors apart from interest rate plays out, which is what the overall investment climate is and how the overall regulatory environment is also. And there, I mean, there is a something that the government can definitely do, which is, for example, the GST rates, where there are talks of it being rationalized. So yeah, all of these factors would also be very important in terms of enabling the private investment demand also to pick up at a time when the global economic environment remains uncertain.
And how do you read the 7.4% growth number, Paras? Because is that a one off, or is it something that will continue and those effects will rub off into the first quarter as well?
Yeah, we do think that it's a one-off currently, because if you look at the data for first Q1 as well, April industrial demand had, I mean, industrial output had declined. I mean, the output growth was just about 2.7%, and the May one is also expected to show a very muted number because of the kind of, the climate change impact, where May was a very, we had the unseasonal rains which impacted electricity output and also steel and cement consumption as well. So that would have an impact on industrial demand. And so yeah, first quarter growth usually is also lower than the fourth quarter. So it would be nearing about the 6.5% mark at the current juncture. But yeah, I mean, it would be lower than what the fourth quarter number is. In fact, I mean, if you look at the RBI's projections as well, they indicate that the first quarter they have kept it at 6.5%. So definitely, it looks below than the 7.4% that we had in the fourth quarter. And also, just to add, I mean, for the first time, if you look at read the governor's address, then the first time they have mentioned that the rate of growth is lower than the aspirational mark, which is the 7 to 8% mark. So that is also the rationale behind the kind of boost aggressive easing that the central bank has given. So definitely, it looks like a one-off as of now, but both, I mean, growth would be hovering at around that 6.5%.
Rajnish, how do you see these numbers, the 7.4% growth number, the GST collections being good, but this that K-shaped recovery in urban demand that still persists? The rural is doing better, of course, because of the agricultural growth and the monsoons, but urban India doesn't seem to be doing as well. At least there are two stories to urban India now.
Yeah, that's the general commentary basically, which is there, that the rural economy, rural demand is doing better than the urban demand. I think I just wanted to make one comment which was there on the 6.5 and the 7.4% growth rate. So one of the charts that you showed was how the government spending has changed during the course of the year. So I think you may see variations in the quarterly growths during a year, also dependent upon the timing when the government is paying out the subsidies and where the government is spending money. But coming to the demand, basically, which is there, I expect that the demand would be very, very important in the coming year. And there are 3 or 4 things which are there, which will have a bearing on the demand. So one is that there was a tax cut in the last budget, and we should start seeing the impact of that tax cut in terms of greater demand coming into the economy. The second thing is that the central government is looking at revising the salaries. We don't know the specific timings, but that again is a positive, gives a greater confidence as far as more money is going to flow in. And then, the service exports continues to do very well, continues to grow. That creates a lot of demand in the urban areas, both for real estate and also for spending with the individuals which are there. So yeah, urban demand, the general commentary is that it's not doing as well as the rural demand, but I expect that demand should be strong going forward for the reasons that I've outlined.
And what about investment? Because you talk to a lot of companies as well. What are companies saying about investment? Because it's a really uncertain environment as far as exports are concerned. We don't know what tariffs will be levied. We don't know whether China will reach a deal first or EU will reach a deal first, or whether India would be able to strike a deal at all. And President Donald Trump, on the other hand, has raised steel and aluminum tariffs to 50%, which will of course hurt about a good amount of our exports going to the US and the world as well. So how are companies viewing that part?
Look, we are in a little bit of an uncertain environment, which is there for some of the reasons that you outlined. However, a trade deal with the US, and equally importantly, what tariffs the US sets on other countries will have a bearing on the investments in India. So, for example, if the tariffs on some of the competing Asian countries that they were announced initially, for example, 40% plus tariff on Vietnam, and similarly higher tariffs than India for countries like Thailand and others, suggests that if they were to be implemented, then the exports out of India could be more competitive. So I think in India at this point of time, one, we need to watch out for the tariffs, not just our own deals, but the deals with the others which are there, which can give us market access, gives an opportunity to get into the global value chains. I think the other very important thing of this Trump tariffs are that it basically is telling the world that get more competitive. So the focus which is there within India on ease of doing business, on reducing the cost of doing business, on attracting other global value chains like Apple. Apple's a great success story in India. Now, one of the reasons that it's a success story is because they have a global market share. So the moment they manufacture in India, you automatically get a part of the global export market. So if we can attract a few more of such players to invest in India and then sell for India, we can see a better investment climate going forward.
Paras, we talked about growth rates being low. We're talking about still about a 6.3, 6.5% growth this year. World Bank had projected 6.3%. IMF is the same, 6.2, 6.3. Even others are saying the same thing. So, and we will remain the fastest growing economy in the world. So, critics would say, what is the pessimism about? Why is that not enough?
Because if you want to get to the developed mark, which is our aspiration to be by 2047, even if you look at the World Bank's report on escaping the middle income trap, which was released in February of this year, that has projected that if India aspires to be at that level, then there should be a sustained growth of 7.8%. And currently, we are definitely way below that mark. And that's where it is all about competing within ourselves, that we can do much better than what we currently are doing, because we have a strong domestic demand. There are other also very positive long-term macro fundamentals are very strong for the Indian economy, but then there are other structural constraints which need to be unlocked, and for the growth to be near that 8% mark on a sustained basis, which currently, I mean, at the current juncture looks a bit difficult, and that's what I mean. The governor also had indicated in his address, possibly for the first time since he had took over in February.
Sir, when we are talking about growth rates, you track macroeconomy very closely. 6.3, 6.5% would have been lauded another time. Right now, we are talking about 8%. So, from that perspective, how do you view those rates, Rajneesh, the 6.3, 6.5%? And why do you think, and what do you think we need to do to get to that 8%?
So, we at EY did a projection a couple of years ago of how big the economy could look like in 2047. Now, if we were to be able to sustain a 6 to 6.5% growth rate over that period, then our projections were that India will become a $26 trillion economy, and the per capita incomes would rise something like 6 times. So it's a high growth rate which is there. It needs to be sustained, and of course, we should not be sitting on laurels and see what better we can achieve. I think it's quite well accepted that the share of manufacturing in the Indian economy should ideally go up, both for us to get a higher growth rate and also for creating more jobs, which in turn creates consumption and makes the economy stronger, which is there. So I think the whole focus, I come back to the point that I made earlier, the focus on making it easier to do business. If you go back and look in history, what changed in 91 was that we did away with industrial licensing, gave more freedom. And similarly, at this point of time, if we can give more freedom to our enterprises from some of the issues which are well documented around inspections and other things which are there, lower the cost of doing business by bringing down logistics cost, bringing down energy costs, and cost of land, the factors of production, then I think we could look at a growth rate which is higher than the current 6.5%. But we should not be pessimistic. It is a good rate. And if we can sustain it over a period of time, you'll see a dramatic change in the living standards in India.
With that, we talk about all the $1 trillion and the $1 billion numbers. Let me take you some charts so that we can make this clear for our viewers. So, India in 2025 is supposed to be a $4 trillion economy. It was just announced. It is heading to be a $5 trillion economy by 2027. This is as per IMF forecasts. We were about 2.67 trillion in 2020, 2.84 in 2019, just before the pandemic, and about 2 trillion in 2014. So that's almost a doubling in about a decade. But here is where the catch is. You look at the data here. The year that these countries became trillion-dollar economies and what was their per capita income. In India's case, it's 2025, the per capita income is $2,880. China was 2008 and $3,500. US was 1984 and 17,000. And Japan was 1993 and 36,000. Now, US has moved about 6 times since, and China in that short period has moved to about 13,000. That's the kind of growth that Rajnish was also talking about, growing 6 times as many years. But my question comes, our per capita income is still relatively low when you compare to the other countries that achieved that mark at that level. Both US and China had the advantage of globalization lifting growth. So, Paras, how are we different and how do we get out of this milieu?
First thing that needs to be done, definitely, if you look at these economies, they are high research and development spending countries where they have done massive spending in innovation. Both, if you look at the share of R&D as a percentage of GDP, then China stands roughly about 2 to 2.5%, and we are 1/5 of that currently. So that needs to be going up quite substantially if we want to climb that ladder in a very significant manner, and in also in a very quick manner. So that is something that has to be done. And then if you look our labor force participation rate, I mean, it is currently at 56%, which if you compare with our, not even these countries, but also even the developing counterparts like Vietnam and Philippines, it is much lower than them. So that needs to be going up substantially. And there, I mean, if one looks much more deeper, then labor mobility has been a key constraint for, especially for women, moving into urban areas where we have seen that the housing is becoming much more expensive. So there, I mean, that needs to be something that needs to be taken care of by the government, because and they have been doing it with the kind of investments the government has been doing in the PM Awas Yojana, and also for the urban areas. So these needs to be kept up and on a sustained basis. And apart from that, I mean, the third, I mean, factor is the tariffs part. We have been having a very high tariffs on intermediate goods, and because of that, that basically keeps the input prices of exporters very high, which hurts their competitiveness. And there has been also a broader acknowledgement from the government part with the kind of deal that has been signed with the UK, and that with the overall tax rates being nullified for 99% of the items. So that gives a good broad indication that there has been a broader acknowledgement of this fact. And if that happens with the US, EU, and also if we have a relook at the RCEP, all of these factors would be great enablers for us to boost our exports, which is a very key enabler for, if you look at these countries, China and US.
Rajnish, going to you, when you look at that chart, one thing comes very clear. 1984, again, there was a boost in globalization around that point of time. It was hyper globalization almost. 2008, of course, we had the crisis, but then after that, there was again a boost in globalization, more trade during that period, if you remember. India does not have that advantage as of now, at least with friendshoring, it might, but so what do we do differently? Because looking inwards can only help us grow so much.
Yeah. So look, one, India has also benefited from the globalization. I think the whole growth which has happened in the service exports is an outcome of the globalization, where large corporations have outsourced their work to India. Now, this sort of outsourcing probably wouldn't have been possible in the 1960s or 1970s. It was possible in the 1990s onwards, as the cost of telecommunication came down and it became much easier to be able to do that. Yeah, we should not be inward looking. And I don't think so that is the focus of the government or of the corporates to look inwardly. So one of and these trade agreements that we were talking about, there's one which was signed with the UAE, there was one signed with Australia, one with these European countries, which is Norway, Switzerland,
The EFTA.
now with the and the discussion with the UK and the US all points to the fact that we are looking outwardly. Now, I'd say this with a caution that when you are looking at trade, this current strategy is very good, and it's been implemented after a pause of number of years, where you're looking at consumption economies, where there may be a natural fit which is there between the strengths of the Indian economy and the needs of these economies. So, for example, a lot of the labor-intensive manufacturing, textiles, footwear, and other industries, we could be making and selling it to these countries. So I think the only caution is that we need to be careful not to on the trade with countries which may be able to compete with us in manufacturing, especially on the labor-intensive side of it. But I agree that we need to look outwardly. That is what the government is doing, and our success in service exports is to do with the globalization which has happened over the last few decades.
Paras, I was talking to somebody, they were telling me that India does not need to repeat the mistakes that China did. So that whole support, the housing market crisis and everything taken into account. Is China the right example to look at in such a scenario, or do we need to chart out a different path? Because that was more of a export oriented economy. We are more consumption oriented, 60% nearly, right? So how does that differ, and what are the lessons from the China story as of now?
Yeah, we need to chart out our own path, and that's what has been the case for us when we did the 1991 reforms. And there, as you correctly pointed out, the following a blanket export-led strategy won't be giving that kind of benefits because we have like our own strengths where we are a consumption-driven economy. But if you look at the share of manufacturing and our exports as well in terms of the world trade, then there is a lot of gap for us and opportunity for us to cover that up. And that has been the case in services exports where we were not there quite up 20 25 years back, but then now we have a sizable share in the overall global services exports, but that has not been the case in the goods part. So there, that indicates that we have that kind of opportunity to close that gap, and that can only be coming from a focus also on manufacturing, and also keeping the balancing act with the services sector, because that has been the key comparative advantage for us. And the focus should be on providing that right balance to both of them, not like blankly focusing on manufacturing. And that could only be done by if we keep that pedal also on the innovation part. That if you look at various services, we don't really have that kind of companies which are the new working in new age services, whether it's the AI having the or robotic engineering and other sort of stuff. We are lacking in that, but there also we the overall innovation has been something which needs to be picked up very substantially if India wants to go to that path, because we have that capacity. As you know, the overall, if you look at the Apple iPhone, the kind of value chain that is there in manufacturing is very low. But if the higher end R&D services that is there is the higher value within that Apple iPhone that is there. And we have that kind of capacity, and we should focus both on both of them. So that I would be saying that a key balancing act is required in services and manufacturing. And manufacturing sector needs to be, given that kind of leeway or sort of liberalized in a manner that service sector was done in the late 90s.
Rajnish, last question to you. You were talking about factor market reforms, right? There is a sense of urgency in terms of those. We've been trying to institute them for a long period of time as well. But given how challenging some of these would be to implement, what would be your suggestion to the government? Which ones to go for first and which ones can it evolve a better strategy at? And what would be that strategy also? I remember a professor once telling me you need a GST council kind of an approach for all reforms, and that might work better.
Yeah, look, the clock is ticking. So reforms are very, very meaningful. And as you also said when you were talking of the GST Council, that the states need to be co-opted in these reforms, because a lot of the issues which are there on the table, like land, labor, and a lot of the inspections which are there, or a lot of the permits which are there for new investments, they are very state level issues. So, for example, if you set up a new hotel or you set up a new hospital, there are hundreds of compliances that you require and they can be streamlined. So, I don't think so there is time to be lost, which is there. I think what we really need to do, and the government's also set up this regulatory commission, which hopefully will push things. I think this needs to be put on a war footing, if I may use those words, which are there. And you really need to get a few people into the room, both from the central government, the state governments, and from the industry who are really impacted, and start looking at each of this regulation and law as to why you're looking at this clearance, or why is this thing coming in the way, and is there a way of simplifying, of eliminating something, of getting into self-certification instead of waiting. So as an example, which is there, can we set up a manufacturing estate, and whoever is managing the estate is given the power by the state government to get a lot of the regulatory approvals, to give the approval. So there are lots and lots of things which are possible. And I also think that there are a lot of think tanks, a lot of individuals and industry associations who have documented the type of changes which are required. I think it just requires concrete action of the stakeholders coming together, of our applying our minds and getting through with these changes. And I think it'll have a tremendous impact on our economy. It'll just improve the competitiveness of the economy, and which is what you need to do in such a globally competitive world.
The clock is ticking and innovation is required. Those are the options that our panelists have pointed out today. Thank you for coming on the show. It was great having you both, and we'd love to see you again. As far as the Indian economy is concerned, the 4 trillion mark and then later on the 5 trillion would be achievable. With the current growth rates, India would tend to grow to that levels. But the point is escaping the middle income trap and not being trapped at that $13,000 to $15,000 per capita income levels. Can India do it? And most importantly, how can it do it better than others have done? The third important part there would be the factor market reforms. Everybody is calling for them. It falls upon government as to how it would institute them. Thank you for watching Beyond Averages with us. We'll be back next week with more news and analysis. Thank you.